Welcome to Cambridge IGCSE and O-Level Accounting. This is the book by June Baptista and published by Hodder Education. Right now, we are moving on to Section 1. We're continuing Section 1, the fundamentals of accounting. So the first unit was Chapter 1, the purpose of accounting, and this unit is Chapter 2, the accounting equation. This section of the syllabus introduces you to what accounting is, the purpose it serves, and the important role it plays in the world of business and finance. Accounting is also the foundation on which modern-day record-keeping, the double entry system, is based. This section explains how bookkeeping is different from accounting and the accounting equation. So we are now in Chapter 2, the accounting equation. By the end of this chapter, you will be able to explain the meaning of assets, liabilities, and owner's equity, explain and apply the accounting equation, and outline the double entry system of bookkeeping. Assets, liabilities, and owner's equity. Accounting records of a business will often start with the owner supplying resources, for example, cash and motor vehicles. From an accounting point of view, the owner is regarded as a separate entity from the business. Therefore, when the owner supplies a business with resources, the business now owes the owner for these resources. This is the owner's equity, or capital, and is represented by resources of monetary value, or assets, that the business now owns. The business benefits from the ownership of assets by using them to generate income. We can show this in form of an equation. Owner's equity, resources supplied by the owner, equals assets, resources owned by the business. Often, people other than the owner, the bank for instance, supply resources to the business. These are the liabilities of a business. A liability is a debt or an obligation owed to lenders or suppliers. The accounting equation. When the business acquires a liability, the equation is altered to owner's equity equals assets minus liabilities. This is called the accounting equation. As this is an equation, both sides of it should have the same value. This makes sense as one side of the equation represents the value of the owner's investment in the business, and the other side represents the net value of what is owned by the business. If we modify the equation, assets equals owner's equity plus liabilities, or liabilities equals assets minus owner's equity. Key terms. Owner's equity in accounting is usually what the business owes the owner. It can refer to funds raised by the owner to fund a business idea. Assets are resources of monetary value that a business owns or are owed to the business. Examples of assets are cash, motor vehicles, trade receivables, and property. Liabilities are amounts that the business owes people for resources supplied to the business. Examples of liabilities are trade payables, overdraft, and loans. Accounting equation is a formula that is used to illustrate the relationship between the assets, liabilities, and owner's equity of a business. It shows that all the assets of a business are provided or funded either by the owner or the trade payables or other creditors of the business. This equation, which is the foundation of accounting, shows that all the assets are financed either with the money invested by the owner or the money received from borrowings. Activity 1. Number 1, define owner's equity. Number 2, define liability. Number 3, explain why owner's equity is a liability. And 4, complete the following table, where in A, assets are $7,000, owner's equity is $5,000, so what are liabilities? In the second one, assets are unknown, Liabilities are $1,350. Owner's equity is $2,450. Letter C, assets are $2,670. Liabilities are $500. And owner's equity is unknown. Letter D, assets are $8,000. Liabilities are unknown. And owner's equity is $3,780. Finally, letter E, assets are unknown. Liabilities are $1,900. And owner's equity is $4,100. Key info. Resources owned by the business equals resources supplied to the business. Study tip. Remember, the equation merely states what the business owns equals what the business owes, either owes to the owner or owes to debtors or creditors. Study tip. If two of the three components of the accounting equation are given, like in the previous activity, you can use the equation to calculate the third. The double entry system of bookkeeping. Every economic or business event will have a dual effect on the accounting equation. This can be seen in the statement of financial position, which reflects the accounting equation. One side of the equation represents all the assets, and the other side represents the liabilities and owner's equity. Both sides should be equal. On the 1st of January 2018, Anita Goswell decided to start a business. Her accounting equation will be assets equals owner's equity plus liabilities. $0 in assets equals $0 in owner's equity plus $0 in liabilities. Number 1. Introduction of owner's equity. On the 2nd of January 2018, Anita opened a bank account for the business named Anita Goswell Trading. She deposited $56,000 cash into this account. Her accounting equation will be assets equals owner's equity plus liabilities. Assets, $56,000, cash at bank, equals $56,000. Owner's equity, which started at 0 and is now raised to $56,000, plus $0 in liabilities as she owes no creditors or debtors. So the statement of financial position will look like this. Anita Goswell Trading, statement of financial position as at the 2nd of January 2018. Assets, cash at bank, $56,000. Owner's equity, $56,000. Key term. The statement of financial position of a business is a statement listing the assets, liabilities, and owner's equity or capital at a specific point in time. It is one of the financial statements prepared at the end of the financial years. It records the assets, liabilities, and capital of the business. So number 2, the purchase of an asset and paying by check. On the 5th of January 2018, Anita purchased inventory for $5,000 paying by check. Once again, assets equals owner's equity plus liabilities. $5,000 inventory plus $51,000 cash at bank, which is $56,000 before minus the $5,000 for inventory, equals a total of $56,000 in owner's equity plus, once again, $0 in liabilities. So the statement of financial position will look like this. Assets, inventory, $5,000. Cash at bank is $51,000. In total assets are $56,000 and owner's equity is also $56,000 as before. Key term, inventory refers to goods that a business purchases for resale. Number 3, purchase of an asset on credit. A liability is created. On the 6th of January 2018, Anita Goswell Trading bought a motor vehicle costing $6,000 from Salient Motors on credit. Salient Motors is now a creditor and must be paid back at some later date. Assets equals owner's equity plus liabilities. So the assets are $6,000 in the motor vehicle, which started off as $0 and is now increased to $6,000. We still have our $5,000 in inventory, and we still have $51,000 cash at the bank. That is equal to the same $56,000 in owner's equity, but now there's an additional $6,000 owed to the creditor in liabilities. So the statement of financial position will look like this. Anita Goswell Trading, statement of financial position as at 6th January 2018. You have assets, motor vehicle, $6,000, inventory, $5,000, cash at bank, $51,000. This motor vehicle has now increased total assets to $62,000. However, Anita did not pay for this with her owner's equity, with the cash that she had, which was the $56,000 cash plus inventory. Instead, she bought it with a liability, a creditor, Salient Motors, for $6,000. Sorry about that. Creditor is $6,000, which equates to $62,000 total for liabilities, and now assets equals owner's equity of $56,000 plus $6,000 in liabilities, $62,000 total. Number 4, payment of a liability. On the 25th of January 2018, Anita paid Salient Motors $5,000 by check in part payments, remember the payment was $6,000, of debt owing. Assets equals owner's equity plus liabilities. $6,000 motor vehicle plus $5,000 inventory plus $46,000 cash at bank, which was $51,000 minus $5,000, equals $56,000 in owner's equity plus $1,000 to the creditor, the original $6,000 minus this $5,000 payment. The statement of financial position will look like this. Assets, motor vehicle still costs $6,000, inventory still costs $5,000, but the cash at bank has been reduced by $5,000 down to $46,000. That means total assets have now been reduced to $57,000. Owner's equity stayed the same, $56,000. The creditor, the liabilities, have been paid off, but only $5,000 have been paid off. There's still $1,000 left. Therefore, owner's equity plus liabilities is the same $57,000 that Anita Goswell Trading has in assets. Number 5, sale of asset for cash. On the 29th of January 2018, Anita sold inventory for cash, $3,000. Assets equals owner's equity plus liabilities. $6,000 motor vehicle plus $2,000 inventory equals $5,000 minus $3,000. Right, so she sold $3,000 worth of inventory. She has $2,000 left. Now that means she should have extra cash. She has $46,000 of cash at bank plus $3,000 cash in hand, the cash given for the sale of inventory. That equals the same $56,000 in owner's equity and the same $1,000 to the creditor. So what you see is that it's just been a shifting of assets from assets being taken out of inventory and moved into cash at hand. So the statement of financial position will look like this. Anita Goswell Trading, statement of financial position as at 29th of January 2018. Assets, motor vehicle still costs $6,000. Inventory went from $5,000, $3,000 was sold, there's now $2,000 left in inventory. The same $46,000 of cash at the bank is still there. However, now there's an additional $3,000 cash in hand, still equaling the $57,000 in total assets. Equity has not changed from $56,000. Liabilities have not changed from $1,000. So owner's equity plus liabilities equals $57,000. Number 6, The owner withdraws assets from the business for personal use. You have to think about this. If you're an entrepreneur, you do have to pay yourself, which means you have to take money out of the business to pay yourself, and that's what Anita is doing. On the 30th of January 2018, Anita withdrew $3,000 from the bank for her own personal use. When the owner withdraws resources from the business for personal use, it is referred to as drawings. This is recorded as a decrease in owner's equity and a decrease in the asset withdrawn. Money is being taken out of the business, completely out of the business, and into the personal account of Anita, which is reducing owner's equity in the business. Therefore, assets equals owner's equity plus liabilities. We know that both assets and owner's equity will go down and liability should stay the same. Assets, motor vehicle, still costs $6,000. Inventory is now still at $2,000. $43,000 is our cash at bank. $46,000 minus the $3,000 withdrawal, and there's still $3,000 cash in hand. That equates to $53,000 of owner's equity, which is owner's equity of $56,000 minus drawings of $3,000, plus another $1,000 owed to the creditor and liabilities. So the statement of financial position will look like this. We have Anita Goswell Trading statement of financial position as at 30th January 2018. Assets, motor vehicle, still costs $6,000. Inventory is now still at $2,000. Cash at bank has been decreased down to $43,000. Cash in hand is still $3,000, but now total assets are $54,000. Owner's equity, it started with an opening balance of $56,000. It has been reduced by the $3,000 in drawings. So total owner's equity is only $53,000, and the liabilities are still $1,000, which equals a total of $54,000, the same as assets. Key term. Drawings is the term given to the value of assets in the form of cash or inventory withdrawn from the business by the owners for personal use. It's no longer business money. It now goes back into the owner's account. The business no longer owes it in owner's equity back to the owner. Drawings reduce the owner's equity. Woo, number 7's a big one. Payment of a business debt by the owner from personal funds. On the 31st of January, so at the end of January 2018, Anita paid Salient Motors $1,000 cash from her own personal funds. This will have the same effect as an injection of fresh equity into the business by the owner. Therefore, owner's equity will increase by the amount of $1,000. Remember, she's taking that money out of her personal account and putting it back into the business to pay off this debt. There should be no change in the assets because it's not the company's money, it's Anita's own personal money. So here we have assets equals owner's equity plus liabilities. Assets are the same. The same $6,000 in motor vehicles, the same $2,000 in inventory, the same $43,000 cash at bank, and the same $3,000 cash at hand. However, owner's equity is increased by $1,000, as this from her own money was paid into the business, and the liabilities to the creditor has decreased by $1,000, as that money was used to pay off the last of the funds owed to the creditor. So the statement of financial position will look like this. Once again, assets, motor vehicle, $6,000, inventory, $2,000, cash at bank, $43,000, cash in hand, $3,000, $54,000 total assets. There are no more liabilities if they have now been paid off, and owner's equity is now $54,000. At the bottom it says, here is a summary of the effect of transactions on the assets, liabilities, and owner's equity in the accounting equation. If an asset increases, then either a liability or owner's equity will also increase. If an asset decreases, then either a liability or owner's equity will also decrease. Remember, assets equals owner's equity plus liabilities, so both sides must equate to the other. If an asset increases, then another asset involved in the transaction will decrease. If an asset decreases, then another asset involved in the transaction will increase. If a liability or owner's equity increases, then another liability involved in the transaction will decrease. If a liability or owner's equity decreases, then another liability involved in the transaction will increase. Think about it. The accounting equation can serve as an error detection tool. Do you agree? Give examples in support of your answer. Activity 2. Copy and paste the following tables with the word decreases or increases to show which effect each transaction would have on the assets, liabilities, and owner's equity of a business. So, in letter A, the transaction is that the owner introduced $45,000 cash into the business bank account. Cash, is that an asset, is that a liability, and is that owner's equity? And if it was introduced by the owner into the business, then what also goes up along with the cash account? Letter B, the business bought goods on credit from Sully and Sons. Goods are now injected into the business and have now increased what the business has. However, the business now owes Sully and Sons. So what does that do to assets, liabilities, and owner's equity? Letter C, Benjamin, a friend of the owner, lent the business $3,000 in cash. Benjamin is not a partner. Benjamin is a friend of the owner, and therefore it is a loan. $3,000 in cash are now in the business, and now the business owes Benjamin $3,000 in cash. Letter D, the business sold goods for cash, $500. Excuse me. So, goods are now decreased by $500, and cash will now increase by $5,000. Sorry, $500. So is that asset, liability, or equity? Letter E, the business paid Benjamin $3,000 by check. The business paid Benjamin, that's the loan. Remember, Benjamin's not the owner here. So the business has now paid off this $3,000 loan from letter C. What does that do to assets, liabilities, and equity? It was paid by the business. Letter F, the business returned goods worth $50 to Sully and Sons. Remember, these were goods purchased on credit. Now we are returning these goods. The goods are being returned, which means they were not sold. Those goods are going back, which should decrease inventory. And it should also decrease the amount owed, considering that the goods were returned. Letter G, the owner withdrew $400 from the business bank account for personal use. So this should have the opposite effect of letter A, where money is taken out of the business and it is being used for personal use. So that should have an effect on either assets, liabilities, or owner's equity. Letter H, the business bought a motor vehicle, $4,500, paying by check. The motor vehicle is something that now the business owns because the business bought it, not the owner. The business bought it, and the business paid by check. So what does that do to assets? What does that do to liabilities? What does that do to owner's equity, if anything? And finally, letter I, the business paid a creditor $58 in cash. What does that do to assets, liabilities, and owner's equity? Types of assets. There are two types of assets, current assets and non-current assets. Current assets include cash and other liquid or near liquid assets. Trade receivables and inventory are some other examples of current assets. If an asset can reasonably be expected to be converted into cash within 1 year, then it is a current asset. For example, the value of inventory increases or decreases as it is bought or sold. The value of a trade receivable also fluctuates when more goods are sold on credit or trade receivables pay off amounts owing for goods received. The cash at bank will also charge with multiple deposits and withdrawals made during the year. Key terms. Current assets are assets that can be sold, used up, or consumed through the normal workings of a business within no more than a year from the date of the statement of financial position. Non-current assets are those assets that the business has bought with the intention of using them for a period of more than a year, such as machinery, motor vehicles, and premises. Liquid assets are those assets that can be quickly converted into cash with no loss in value. Trade receivables are businesses or individuals who have received goods or a service from the business on credit with the understanding that payment is due within the credit period. Non-current assets are those assets purchased with the intention of keeping them for their entire economic life, which is always more than a year. They are not bought for resale, but for use within the business to generate revenue. For example, motor vehicles, machinery, and premises. Types of liabilities. Current liabilities, as the name suggests, are those debts that must be paid within 1 year. Trade payables are a good example of a current liability. They represent suppliers from whom a good or service has been purchased. These trade payables will normally expect to be paid within a specified period and are known to give discounts for early payment. Another example of a current liability is a bank overdraft. Non-current liabilities are those amounts owed by a business which are not due to be repaid within 12 months of the statement of financial position date. For example, a long-term bank loan. Here's a more detailed version of Anita Goswell's financial statement, or statement of financial position as of the 30th of January 2018. So here we have Anita Goswell Trading, statement of financial position as at 30th January 2018. Non-current, so now everything is gonna be split apart into current assets and non-current assets, and there's only current liabilities in this scenario. But as an example, a non-current liability would be like something long-term, like a bank loan. So non-current assets would be the motor vehicle. That's the only non-current asset, the only thing that cannot be completely used up within a year, $6,000. The current assets, inventory can be sold within a year, $2,000. The cash at the bank can be used easily within a year, $43,000. And the cash in hand can also be used within a year, $3,000. Total current assets are $48,000. Total assets are $54,000, and that's the double underline showing that is the complete number for total assets. Owner's liability and equity. Owner's equity is the opening balance, $56,000, less those drawings of $3,000, $53,000, and current liabilities, as they're being paid off even within a month, the creditor is $1,000, so total owner's equity and liability, $54,000. Key terms. Current liabilities are those debts that must be paid within a year from the date of the statement of financial position. For example, trade payables and overdraft. Non-current liabilities are those debts that do not need to be paid within a year from the date of the statement of financial position. For example, a long-term bank loan or a lease. Activity 3. State how each item would be classified as an asset or liability. A. Buildings and property. B. Machinery. C, trade receivables, D, trade payables, E, overdraft, F, cash in hand, G, loan from M Apple, a friend, H, inventory, I, motor vehicle, and J, equipment. So would each of these be either an asset or a liability? Think about it. Every business transaction, every time you see that word every, pay attention. So every business transaction results in two changes in the statement of financial position. Do you agree? Work with a partner to decide your answer. So look back at what we've done with regards to double entry bookkeeping. Does every business transaction result in two changes in the statement of financial position? We have seen that every business transaction has an equal and opposite effect on at least two of the components of the accounting equation. It is impossible to prepare a statement of financial position after every business transaction. Therefore, the two effects of every transaction are recorded as part of bookkeeping in the books of account. An account is a physical place where information concerning an asset or liability or owner's equity is recorded. The books in which accounts are recorded are called ledgers. When a transaction takes place, we enter the data relating to that transaction in the relevant accounts, making sure that only the accounts affected by the transaction are used. Hence, the balances on these accounts are either increased or decreased. Therefore, for every business transaction, there will be two entries made in two accounts, hence the term double entry bookkeeping. Regardless of which accounts are affected by a transaction, the accounting equation will always hold and the equation will always balance. Exam style questions. The following multiple choice questions should be completed within 5 minutes. 4 possible answers are given for each question, and you must choose the one most appropriate answer. Number 1, what is the accounting equation? Is it A, assets plus liabilities equals owner's equity? B, assets plus owner's equity equals liabilities? C, assets minus liabilities equals owner's equity? Or D, assets equals liabilities minus owner's equity? Number 2, which definition is not correct? A liability is what a business owns. B, an asset is a resource that a business owns. C, owner's equity is what the business owes the owner. Or D, the accounting equation is reflected in the statement of financial position. Number 3, a business had the following assets and liabilities on the 6th of June 2016. Motor vehicle, $5,900. Bank loan, $6,000. Cash at bank, $49,000. Trade payables, $800. Inventory, $2,100. Premises, $30,000. What was the value of owner's equity? A, $80,200. B, $81,200. C, $81,800. D, $92,200. Don't forget the accounting equation when you're answering that question. Number 4, which statement is correct? A, resources owned by the business equals resources supplied to the business. B, resources owned by the business equals resources owed to the business. C, resources owned by the business equals resources supplied by the business. D, what the business supplies equals what the business owes. Number 5, which statement is correct? When the owner deposits money into the business bank account, it is called drawings. B, When the owner pays a business expense from personal funds, it is called drawings. C. When the owner supplies a motor vehicle to the business, it is called drawings. D. When the owner withdraws money from the business bank account, it is called drawings. The mark allotted to the structure of the question below is a guide to the length of time that should be taken to complete it. For example, this question has 3 marks for A, but 5 marks for B, so the for 6B should take longer for you to answer than 6A. It says Amy Frox has completed its first year of trading, which ended on the 31st of August 2018. Using the information below, A. Calculate the owner's equity at the 31st of August 2018. B. Prepare Amy Frox's statement of financial position as at the 31st of August 2018. We have machinery, $15,000, inventory, $10,000, trade receivable, $5,000, trade payable, $2,400, cash at bank, $29,000, premises, $100,000. Now that those exam style questions are over, here are some chapter review questions. So the first one, Simran's accountant prepared a statement of financial position at the end of her first year of trading on the 31st of December 2018. Simran was not familiar with some of the terms used in this statement. State the meaning of each of the following terms. A. Drawings. B. Assets. C. Trade payables. D. Current liabilities. E. Non-current assets. Number 2. Copy and complete the following sentences, choosing from the words below. Fixed, equation, accounting, drawings, current liability, capital. A. Owner's equity is also known as blank. B. The statement of financial position reflects the blank blank. C. When the owner withdraws cash from the business bank account for personal use, it is called blank. D. Non-current assets are also known as blank assets. E. Trade payables is an example of a blank blank. 3. Explain why owner's equity is a type of liability. 4. The following statements refer to the effect of transactions on the assets, liabilities, and owner's equity in an accounting equation. Copy and complete the following table by entering true or false for each statement. Statement: if an asset increases, then either a liability or owner's equity will also increase. True or false? If an asset increases, then another asset involved in the transaction will also increase. True or false? If an asset decreases, then either a liability or owner's equity will also decrease. True or false? If a liability or owner's equity increases, then another liability involved in the transaction will increase. True or false? If a liability or owner's equity decreases, then another liability involved in the transaction will increase. Number 5. Copy and complete the table below and place a tick against those items which are correctly classified. So we have assets, furniture and fixtures, machinery, bank loan, overdraft, property and buildings. Liabilities, we have trade payables, equipment, inventory, trade receivables, and cash in hand. Number 6. Lazarus Trading started business on the 1st of January 2018. The transactions shown below took place in the first week. Calculate Lazarus's owner's equity after all these transactions have taken place. You are not required to prepare a statement of financial position after each transaction. January 1st, Lazarus deposited $45,000 into the business bank account. January 2nd, Lazarus bought a motor vehicle costing $6,000 on credit from James Motors. January 3rd, Lazarus borrowed $3,500 from Jennings. January 6th, Lazarus paid Jennings cash $2,000 in part settlement of his debt. January 7th, Lazarus withdrew $3,000 from the business bank account for his personal use. Now that we have reached the end of chapter 2, the revision checklist. In this chapter, you have learned what is meant by assets, liabilities, and owner's equity, what the accounting equation is, how to apply the accounting equation, what is meant by the double entry system of bookkeeping, that every transaction has a dual effect that affects the accounting equation, and how to use the accounting equation to prepare a statement of financial position. That is it. Well, that is it for Chapter 2, Cambridge IGCSE and O-Level Accounting by June Baptista, published by Hodder Education. Now that you have finished, once you have completed all of your work and you have answered all of the questions in this unit, we are ready to move on to Chapter 3 and the second section of this accounting course. And I will see you in the next video for Chapter 3. Bye.